Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, joining me today, Jeremy Rettich over in Brentwood with Virtue Capital. Jeremy and I are going to be, in fact, one of the things, I haven't done this, I've been so excited about the show today. One of the things we want to share with you, if you want to call the office, if you'd like some help with your portfolios, if you'd like to get an investment analysis, if you maybe, I can get Jeremy to come in and the two of us sit together with you and talk to you a little bit more about some of the strategies we're sharing. So if you'd like to dig down even deeper into your specific situation, not in general as we're of course doing here, just call my office. The number is 615-376-5325. And when you call the office, we're not going to just do the investment analysis. It's going to be a full-blown comprehensive financial plan. Now, if you just want to come in and just talk about investments, if you'd like to do that, we'll accommodate you, we'll help you with that. But if you'd like to get the whole enchilada, if you will, to be able to get the full comprehensive plan where we not only get into just the investment piece, but we delve into your retirement income. We can talk about tax-efficient retirement income, how we can minimize taxes on your income as you're taking it out of those retirement accounts in retirement, because that's one of the big ones, right? We build up all that money in retirement that we're going to need to draw down on, and how do we do that while minimizing taxes? We've been able to defer them when we're putting it in, but keep in mind, you got $1 million as an example in a retirement account. How much of that is really yours to live on? And it depends, of course, on how much tax you're going to have to pay on it as you take it out. If you're paying a 20% tax, 20% of $1 million, that's $200,000, right? So really, you've only got $800,000 that's yours. And what if you're paying 30% tax? Now you only got $700,000. So you see how important managing your taxes can be as well. So we're also going to talk about tax-efficient investing. And there's a way to do that in with what we're sharing with you today. That's another part we'll delve into when you come into the office. So if you'd like this kind of planning, again, 615-376-5325 for your specific situation, a personalized plan to help you make sure you're able to attain and maintain your standard of living, your quality of life, no matter how long you live, never have to worry about running out of money. So this plan, I'm going to be able to show you, right? We're going to look at your income, your expenses, your assets, your liabilities, and I'll show you your financial future based on the things you're doing today, and then share strategies like we're talking about today in ways to improve that future. All right? Wouldn't it be great if you knew in advance the choices that you have today when you're sitting down trying to decide about what to do, if you knew what the outcome would be prior to making the choice? Make it a lot easier, right? Well, that's what we're going to show you. We'll be able to show you your financial future and help you improve it. So again, 615-376-5325. When you call in, we'll get your information, send you out a checklist of things to bring to your appointment with me. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. So again, if you'd like to share, and when we come in, we're going to get Jeremy over with it. We'll come in and meet with me. We'll go over everything, get it set up, and then I can, if you'd like to have Jeremy as a part of our meeting, we can arrange that too. Isn't that fun? All right.
And Hank, just one comment
Sure.
I want to throw out there. When I meet with prospective clients, and this just, I wanted to share this with everybody, just given what you just touched on and what you were offering there. One of the first questions I ask them is, tell me about your income plan. And literally 8 or 9 times out of 10, I get a blank stare. And they say, well, I have all these assets, which is great. It's great that you've worked hard and accumulated those assets, but now at that stage of life, you need an income plan, right?
Yes.
What taxes are you going to pay? What are you factoring in for inflation? Where are you going to draw money from, and in what order, and why are you doing it in that order? And it always takes me back to something I had read years ago. Hank, I'm sure you've read it as well. And it was a survey that was done, I don't remember by who, but it went on to say that people spend more time planning their vacation than they do their retirement. And so if you don't have an income plan, I would encourage you to come in and sit down with Hank and I and have an income plan put into place, whether you implement it with us or not. But you've got to know where you're going to draw your income from and in what order and why you're doing it. It's just paramount. Number one fear of retirees is outliving their income.
Absolutely. Running out of money. Imagine you're up in your mid 70s or 80s even and having no resources to enjoy life and to provide options for a more comfortable quality of life. And this is in that survey that Jeremy talked about. That's I mean, imagine people are spending more time planning for a 2-week vacation than they do for 20 to 30 years of their lives in retirement, right? Doesn't make sense. So having a plan is so important. What's that old adage, right? Failing to plan is planning to fail. Let's plan to succeed. Let's have a plan. All right, we're going to go to this next slide. This is one that I really love, Jeremy, that this is a diversification in the average investor. I've talked about using Dalbar's quantitative report that they put out each year, and it shows, and I've shared with you here in the past, how this is where the average investor gets so much less than the market return, and this goes to what you were saying, Jeremy, about emotion-based decisions.
Yeah, looking at the chart here, it may be a little hard for you to see, but what we're looking at is a 20-year time frame, so 2 decades, so a very long period of time, and we're breaking down, or actually J.P. Morgan is breaking down how different asset classes performed during that time frame. And the S&P 500 over that 20 years was up just over 6%. A 60-40 portfolio, which is very common, was up 5.6%. Just bonds over that 20-year time frame was up 5%. And then if you look to the far right, the last 2 columns there is inflation was up 2.2%, and to the far right is the average investor at 1.9%. So the average investor didn't keep up with inflation, so they lost buying power. And one of the biggest reasons that the average investor has such a poor return is because they're buying and selling based on emotion, right? And to Hank's point earlier, last year, the 30% decline in 22 trading days left many investors not able to make a change, right? Which actually, partially due to, in a big way, stimulus, it benefited them because of the recovery. But buying and selling based on emotion can cause you to have very poor performance. And that's why when you look at a consistent return, you want to follow the plan. You want it to be a mechanical, repeatable plan that you're not factoring in or making decisions based on emotions. And we as humans, we tend to do that in every aspect of our life, which doesn't usually work out for you very well if you're using emotion in your investments.
This is one of those areas when we talk about risk tolerance, it's a lot. This is an area where risk tolerance is really tested, is of course during bear markets. When you're sitting in the comfort of your advisor's office and you're filling out a questionnaire and they're asking you how you might react if the market dropped 10% or 15 or 20 or 25, and they're trying to gauge how much risk you can tolerate, how much you can be comfortable with before you bail out completely and go bury your money in a mayonnaise jar in the backyard or something, right? So what the problem with that is, of course, is that it isn't comfortable level. You're not, when you're sitting in an office and you're, I can do that. I'm going to stay invested. I'm this, I'm that. And in the market, you get your actual statement, and the market has dropped 10%, and you just lost, $100,000. Now, how does it feel? Okay, are you still going to be comfortable and recognize what we're talking about here in terms of that emotion welling up and I just lost 100,000. What's going to happen? Am I going to lose more? And then, in fact, I'll give you an example. In 2000, I remember having clients coming in about the middle range of that bear market saying, when are things going to get back to normal? Because that first year, that 10%, you lose 100,000. The second year, guess what happens? It dropped 13%. Now I just lost another $100,000. I'm getting really nervous here. When are things going to get back to normal? Surely we're through the worst of it. And what happens in 2003, or 2002, excuse me, in 2002 it dropped 23%. It doubled up. Now I just lost $200,000. Oh my goodness, I've lost $400,000 over 3 years. If I had the gumption, if I stayed invested, okay, how many people just said, no mas, I'm out, okay? I'm not going to do this. This is this emotion, and that's why having someone, a good coach on your side, a good advisor that's going to keep you disciplined. But how about this? How about we add in some strategies to minimize that volatility where you don't lose that amount of money? Because a 60-40 portfolio, by the way, all right, the asset allocation models that I talk about all the time, over that same period was basically just down a few $1,000s. Way easier, all right? In 08, when the market dropped almost 40%, how about an asset allocation model where you maybe only lose half of that? Or how about, I'm going to give you a teaser here, when we come back, we're going to talk about how using dynamic strategies or tactical strategies may have been able to protect you even more from losses during these big bear markets. Wouldn't that be fun? Wouldn't it be a lot easier as far as your risk tolerance, as far as your comfort level, peace of mind, if you knew if I do run into, if this was going to happen, if the next bear market, I've already got a plan in place that's going to protect me, that's going to protect my assets during that period. All right? We'll share that with you after this break. Join us here. We'll be right back on the Retirement Report.